Welcome back, everyone. In today's lecture, we are going to talk about the Greeks. To pull this thread together, here's what we're going to cover on the agenda. So, we're going to spend the lecture working through, as I mentioned, the option Greeks. What these are partial derivatives of the BSM model, pricing model with respect to each of the individual inputs. So the pedagogical arc here moves from theory to mechanics and working on a dynamic hedging example. And then we'll move into a multi-Greek hedging example. And finally, at the end here, talking about the practical limits, culminating in the discussion of the largest one-day crash in market history in October of 1987. So let's do that. So um, on segment one here, we're going to talk about a little bit of motivation here. So we're going to set this up, this example, and this is an example that we're going to come back through throughout this lecture. And so what is this setup here? We're going to set up this example as a bank selling a European call option. So specifically here, we've got a bank that sold, a thousand call options, which gives you them exposure, right, to a written exposure on 100,000 underlying shares. We're going to keep it simple. It's going to be non-dividend paying stock. So we sell this option and we receive the bank, right? We receive a premium of $300,000. Um, Now, when we've sold this option, you got to remember we're short this call option. So we're technically short volatility, right? Because volatility is what gives options their value. Now, the Black-Scholes-Merton model, given these inputs, so here's our input parameters. We have the share price at $49, right? So that's the shares we've written this call option on. The strike price for this call option is 50. Here's our risk-free rate of 5%, standard deviation of 20%, and our time to maturity is 20 weeks. So when we plug all this information in, the Black-Scholes-Merton model gives us a value of $240,000, right? So it looks like we have, on paper at least, we've booked a $60,000 profit. But the apparent margin here, that $60,000, is what we're going to try to lock in. The whole problem here of dynamic hedging, which is where we're going to be moving into here, is how does the bank hedge its risk to lock in the $60,000 in profit? So we're going to need to be trading in the underlying stock. Okay. So let's walk through the example here. So before we get into the Greeks properly here, let's see why two potentially obvious strategies don't really work. Okay, so for the first one here is the naked position. That is, we take no action. It means we pocket the $300,000 and do nothing. If we do that, right, then we're just praying that that the option finishes out of the money. Um, Conversely, we can compare it to like the covered position. Covered position would mean we borrow, 100,000 shares times $49. That's the share price. So we borrow $4.9 million to fully pre-buy all the underlying shares, such that we're hedged, right? So that's a covered position, right? You buy the underlying, you sell the call option. That's a covered call, right? So that's the coverage. Now, let's talk about the extremes here. With a naked position, if the share price goes up, right, if it's above the strike price, let's say it rallies to $60 per share. Well, then the bank owes, $1 million on the calls, but they're not holding any shares, right? So they're going to lose effectively $700,000, right? Because we got to pay that $1 million difference. We receive the 300,000, so we book a substantial loss here. Now, with a covered position, if the stock price crashes, say the share price falls below the strike price, well, then the bank is holding, you know, say the stock crashes to $30. Now the bank is holding $3 million worth of stock against an option that's worth zero, right? So we borrowed 4.9 million. It's only worth 3 million now. So we're out 1.9 million on the shares. So neither of these, positions are particularly attractive for us from a hedging perspective, right? In both extremes, we're exposed to very large losses. So this requires a dynamic approach to the hedging process here. So let's take a look at something called a stop loss strategy. This is going to be our first, sort of simple attempt, if you will, at dynamic hedging. Now, this approach is relatively simple. And essentially, when the essential idea here is that we hold shares only when the option is in the money. And conversely, when it's out of the money, we don't hold any of the shares. Okay. So essentially, when the share price reaches $50, right? So say it moves from 49 and starts going above $50, we buy 100,000 shares in the underlying, right? So then we're hedged because that money's in the option at that point in time. So we could deliver the shares against the call option. Conversely, when it's out of the money, when the share price falls below $50, then we would sell 100,000 shares, right? So in that case, if the share price is above the strike price, the option's exercised, we hold the 100,000 shares as I mentioned, we deliver the shares to that call buyer. And vice versa, we're not holding the underlying if the share price is below the strike price, so no delivery is needed, not a big deal. So the apparent cost looks, naively at least, that the strategy is this payoff of the max between the share price and the strike price at maturity or zero, right? That's exactly mirroring the call options payoff. So the problem is, this is rather naive, and we're going to see why this intuition is dangerous in the next step here. Where does this thing fail? First of all, um, we are actually buying, right? We can't actually buy exactly at $50 per share, right? So we're typically executing at $50 plus some epsilon amount, 50 cents, 10 cents, 2 cents, whatever, times 100,000 shares on the way up. And the same thing when we're selling on the way down, some $50 threshold minus some epsilon, 10 cents, 20 cents, what have you, on the way down. So each round trip locks in a loss. Even though that loss is, epsilon small, it compounds over time, right? Each time we do this. Number two, and this is probably worse, is that stock price oscillates in the case where stock prices will oscillate in and around the strike price. So each time the stock price crosses through the strike price K, you have to do another round trip, right? So in a noisy market or a really volatile market, this could happen dozens of times, right? And each crossing bleeds more and more money. Third here, if you look at simulations, it shows that the strategy's variance is enormous, and its expected cost is expected to far exceed the theoretical, the max of S0 minus K here, or zero. So the stop loss approach here, this naive kind of stop loss approach, does not necessarily replicate the option very well. So what we really need to think about is a hedge that's driven by the option's actual sensitivity, not necessarily by its moneyness. That is sensitive to the price of the share price S. So what we can do instead is to hold a fractional share of the position that mirrors how the option moves when the share price changes, right? And so that fractional amount is what we call delta, right? And so that's the subject of our next segment here. Here we're going to talk about the first order sensitivity to the underlying share price. This is called delta. Now, definitionally, delta is just the first partial derivative of the option price with respect to the underlying shares. It basically tells you how much the option price moves for a $1 move in the stock. So for a long call position, delta ranges between 0 and 1, right? So if it's deep out of the money, um, you know, call option, then delta's close to 0. If it's deep in the money call option, then delta is going to be near 1. And of course, if you're at the money, then the delta is going to be near zero point 0.5. Okay. For a put option, it's delta ranges between -1 and 0 for a long put option. The intuitions are exactly the same in terms of moneyness. It ranges basically, from a -1 if it's deep in the money, close to 0 if it's out of the money, and then of course equal to -0.5 zero point 0.5 if it's at the money. So if you take a look at the geometric picture over here, you'll notice here that delta is the tangent line to the call price at the current stock price, right? So the stock price here is on the x-axis, of course, and we have the option price on the y-axis. And so the actual call price in this example is the curve line. So delta is a linear approximation, right? And the slope of this line is the delta, the slope of this tangent line at the current stock price. So in this case, the delta is 0.6. So it's, slightly in the money, as it were, right? Um, Now, here's some of the core mechanics of how we can utilize this intuition of delta to hedge a position. And the way we do it is to match the option stock price sensitivity with shares. So what do we mean? Okay, here's an example. Let's say we sold calls equivalent to, 1,000 underlying shares here. Okay, so each call is going to, for our example here, um, these the share price is $100, the call price is $10, and then we can calculate the delta, kind of coming off the last slide here, as zero point 0.6. So since we've written this exposure, we have a negative delta exposure. That is, on 1,000 calls times zero point 0.6, we have a short call exposure of a delta position of -600. Okay. So in order to neutralize this delta exposure, -600, it's pretty straightforward. That is, all we have to do is buy 600 of the underlying shares because we know that a long stock has a delta equal to 1, right? And so that effectively nullifies our exposure because, again, our exposure is 1,000 written call options, hence the negative sign here, times the delta of zero point 0.6. And here's the long position in the shares that we just bought. 600 shares times a delta of 1 gives us a delta neutral hedge, right? Now, something to keep in mind here is that this is just a local hedge here. Um, so for and it works for small price changes, right? A few cents here and there. Now, as the share price changes, the delta itself changes, and that's something called gamma, which we'll talk about in the next section here. But as the share price changes, then we have to rebalance the hedge. Okay. And if we continuously rebalance this hedge, then the strategy will fully replicate the options payoff and approximate what the Black-Scholes-Merton model says that the option should be worth. Okay. So that's the whole story of dynamic hedging. Now, in terms of the characteristics of a delta for the call and the put option, um, both follow directly from the partial differential equation that the Black-Scholes-Merton model gives you. So for a call option, for a European call option on a non-dividend paying stock, the delta of a call option is actually equal to N of D1, right? Which of course is always between 0 and 1 for a call option. The corresponding delta of a put option is N of D1 minus 1, which also has that range, as I mentioned before, between -1 and 0. So notice the symmetry, right? The call delta plus the absolute value of the put delta is going to be equal to 1. And In practice here, the um, the absolute value of delta is often interpreted as the risk neutral probability that the option finishes in the money. So this is useful for back of the envelope thinking, even though it's not exactly equal to, the true underlying probabilities. In terms of how delta changes with respect to changes in the stock price, if we have stock price here on the x-axis and delta here on the y-axis, for the call delta, again, it ranges between 0 and 1, and you'll notice that it approaches 0 if it's way out of the money, it approaches 1 if it's way in the money, and where it has the most slope is when it's at the money, right? So this steepness near the strike price is that gamma that we'll talk about in the next section here. And for a put delta, it looks exactly the same, except it's range bound between -1 and 0. But it has the same sort of interpretation here. Now, this chart shows what happens to delta as we approach expiration dates. So for in the money options, right? So let's say, for example, you have a strike price of 40 and the share price is at 50 here, so it's in the money. As you approach expiration, which is moving in this direction towards the left on the x-axis here, as you approach expiration, the delta climbs towards +1, right? So this is for a call option. Um, and this is basically indicating that the option will almost certainly be exercised, so it behaves more and more like the stock itself as it approaches maturity. For out of the money options, the one down here, the opposite's the case, right? So this is where the strike price is 60 and the share price is 50. Then the delta falls towards 0, which is basically saying the option will almost certainly expire worthless. For the at the money option, um, then delta basically stays anchored at and around zero point 0.5. As you notice, it approaches zero point 0.5 as it approaches maturity, which basically says that exercise is a coin flip right up until the end. So the intuition here is that as your time runs out, randomness in the future stock price tends to shrink, and the option's fate becomes more determined by its current moneyness. Now, in terms of hedging delta dynamically, the one and done hedge from setting up our delta exposure like we did in the last example where we bought 600 of the underlying shares, it won't work, which is to say that hedging requires a dynamic rebalancing because delta changes not only because share prices change, right? Delta is a local hedge. It's valid for small moves in the share price at a particular moment in time. Um, so it has to be changed with changes in the share price, changes with time to maturity, and changes with volatility, specifically implied volatility, which we'll talk a bit more about later on. And so the strategy here is to be, ideally continuously rebalancing this to replicate the option's payoff, such that it will earn, exactly the BSM value. In practice, of course, this hedging tends to be a bit more discrete as opposed to continuous. So perhaps daily or even perhaps weekly, which will create some, drag or cost in terms of the hedging program in the example that we're going to pick up here. So here we're coming back to our running example. So we're going to actually trace the bank's hedging strategy week by week. So here's our rebalancing. So our initial setup, right? We shorted those 100,000 European call option. Um, if we calculate the initial delta of that position, we see that it was 0.522. Okay. And so what we would do, of course, is buy 0.522 times 100,000 shares, or we'd buy 52,200 shares in order to hedge this written call position. And since they are, $49 per share, we end up spending $2.56 million. And how do we do that? Well, we borrow this amount, right? And so when we borrow this amount, of course, we're going to incur some interest costs here. So we got to keep that in mind. So that's the initial setup. And then each subsequent week, for example, let's say we're doing a weekly rebalancing, we're going to recompute the delta N of D1 given the current share price and the current time to maturity T, right? And the formula is the same as just multiplying delta times the underlying share count here. And we'll buy or sell the difference from our initial setup. Remember, our initial setup was to buy 52,200 shares. Okay. So quickly, the strategy is if the share price falls, that means delta is going to fall. We can sell some of the stock. If the share price rises, well, delta is going to rise because, right, it's more probability of being in the money. So we want to buy more stock to hedge that position. So the core intuition to take away from this is that, when we're hedging using delta, we're mechanically buying when it's high and selling when it's low throughout the option's lifetime. The average difference between the buy and the sell cost, that spread, the buy sell spread, that's going to be the cost that the hedger, us, the bank, are going to have to pay. Okay. So here's two scenarios from this hedge, right? So let's say it's scenario one, the option finishes in the money, which means the share price increases over times over the next 19, 20 weeks. Okay. And so when we set up the hedge to begin with, remember that it cost us a certain amount to set up this hedge. And it was $2.56 million, right? Roughly, because the delta at that time was 0.522, right? So that's the initial setup. And so over time, you'll see the delta increases, meaning we're buying more shares of the underlying. Starting from our cumulative cost on day one, right? $2.56 million, we'll call it. And our cumulative cost of buying more shares increases over time such that by the end of week 20, right, the cumulative cost of all the buying and selling plus the interest that we're paying on the borrowed money is $5.263 million. So the net cost above the strike price, right? So we deliver the 5 million, right? So this five right here in front of the comma, that's the $5 million worth of shares we'll deliver against the call option because it expires in the money, right? So our shares get called away from us because they exercise it against us. So our cumulative cost is the remaining 263,000 and change, um, above that strike receipt. That's our cost for hedging this program. Now, the Black-Scholes-Merton value at the inception, if you remember from the first slide, was 240,000. So the difference, of this $23,000, 240 relative to 263,000, right? This is our hedging cost. That difference between those is essentially the slippage because we're not continuously rebalancing this. We're only rebalancing it weekly on a discrete basis. So, theoretically, if we did this continuously, we would convert exactly towards the Black-Scholes-Merton model cost of $240,000. In practice, cost a little bit more. And we can show a very similar example with weekly rebalancing. We're roughly going to have this discrepancy in either direction of the price move. All right. So in scenario two here, the option is going to finish out of the money. That is, we know that it's going to become clearer over time that the option is going to expire worthless. That is, delta approaches zero through time. And you can see this over the weeks, right? So how do we, account for this? Remember, as delta approaches zero, we're selling the shares so we can basically repay the loan that we took to buy the shares initially, right? So again, the setup on day zero is $2.56 million. And we're getting charged some interest, of course, over time. And then as we move through time and the share prices fall further out of the money, all we're left with is none of the underlying shares in week 20. So we don't have to deliver because we're not going to deliver anything against the call option. The call option expires worthless here. And all we see here in terms of our cumulative cost is the actual cost of rebalancing of $256,000, which, again, is pretty similar to the cost of hedging it if the share price went up in the prior slide of 263,000. Again, it's going to be different than the Black-Scholes-Merton price of $240,000 because we're not continuously rebalancing this. Rather, it's because of our discrete weekly rebalancing frequency. Now, that's the takeaway here. The two scenarios, same intuition. The cost is approximately the Black-Scholes-Merton cost. And again, this error between the actual practical cost of hedging this position relative to the Black-Scholes-Merton model gives us this bridge to our next section. This error is going to grow between the two, prices, the actual price versus the theoretical price. The more curved the option price is with respect to changes in the share price. And that's, something we call gamma, and that's also something we can actually take care of, right? We can, also hedge for this gamma era as well. And so that's where we're going. So gamma is this curvature of the option price with respect to changes in the share price. So why did we have that added cost in hedging? Remember, we were just using delta. Delta delta hedging works for small changes in the share price. So, for example, at S0 here, if you look at the graph here on the bottom, we'll see that at S0, the tangent line to the pricing curve, which is delta, um, gives us an approximation for the option price change with respect to changes in the share price for small moves around the share price, the initial share price. And you can see that here. There's not much sort of daylight between the tangent line and the share price line, or the option price line. Apologies. But as you have larger and larger moves in the underlying share price, that is, if the share price moves from S0 to S1 here, well, that's a pretty big jump. And the tangent line gives us an approximation, which is identified here as C prime. Um, but the true option price moves further up to C1, right? That is, it moves up to slightly above where C prime indicates. So this vertical gap, right? This vertical gap between C1 and C prime here is the hedger's residual loss, if you will, after rebalancing. And you'll notice here that it grows quadratically, meaning there's an exponential here in the size of the move. So the larger the move, the more painful, basically, in terms of the cost or the slippage in the hedging program. And so we refer to this convexity, that is the shape of the option pricing curve, right? We call this the gamma of the option price. So this convexity is actually called gamma. In terms of the definition for gamma here, well, gamma is just the second derivative. Formally at least, it's the second derivative of the option price with the change relative to the change in the with respect to the underlying shares. Another way to put that is it's the change in the delta with respect to the underlying share price, right? So for a non-dividend paying European option, then this call option, or the gamma, sorry, generally speaking for both, is equivalent to this closed form solution called n prime of D1 divided by the share price times the volatility or standard deviation times the square root of time to maturity. Okay. Now, something to keep in mind here is that n prime is different than n prime of D1 is different than n of D1. Here, n prime is representing the the height of the bell curve under the normal distribution. So this is the normal PDF, we call it the probability density function. So it's the height of that point on the curve at D. And it's not the entirety, it's not the entire cumulative distribution function at n of d. Said differently, I'll draw you a picture here, right? So imagine this is a normal bell curve, right? Assume I drew that symmetrically. So this is our, say, our mean return. If we're at a point here at D1, well, our n prime of D1 is actually the height, right? The height of the curve evaluated at this point. This is n prime of D1 for those who are interested visually. Whereas n of D1, right? N of D1 is actually the entire area under the curve summed up, right? The cumulative density function, as opposed to the probability of observing that point in time. It's the entirety of this region here. Um, so in terms of the interpretation of gamma here, we'll see that gamma is largest when time to maturity is short, and also when the option is at the money. And thirdly, here, when volatility is lower, we get more action in gamma. That is, it's larger. So mechanically, basically, the more curved the option pricing relationship is with the underlying shares, then the more rebalancing risk you have in this particular example or on a particular option. So graphically here, the pricing function for gamma is most curved for, and I mentioned this before, for options that are, in this case, at the money. So the share price at 40, the strike price is 40. This is at the money here. And it's most curved when it's at the money and it's really close to maturity, and that's what you see here. With this is gamma graphed on the y-axis here. So at the money, short time to maturity, you have the highest gamma, as it were. So it makes this interpretation pretty concrete. If you look at the time to maturity of 2 years, there's not much going on in terms of changes, right, in gamma. But as you approach maturity, and if it's at the money, your gamma is particularly pronounced. So, sort of the practical implication here is that short dated at the money options are where gamma traders like to play. This is where there's most curvature, and what we'll see very shortly, this gamma comes with the most theta, i.e., time to maturity problems as well. And its biggest sensitivity to these small moves. You can see how quickly gamma changes as the share price changes. So let's take a look at an example here. Same setup as before. We've got the share price at 49, strike price at 50, risk-free rate of 5, 20% vol, 20 weeks to maturity, and no dividend. So if we plug all that information into the gamma equation here, we'll calculate a gamma of 0.066. So what does this mean? It means that if the share price rises, excuse me, if the share price rises by $1, then the delta is going to rise by 0.066. So another way to interpret that is on our running example here is on 100,000 underlying shares, the call options that we wrote, the bank must buy an additional, right, 6,600 shares to stay delta neutral. So gamma gives us, again, that change in the delta. Um, and the implication here, of course, is that as the gamma increases, then we're going to have more frequent rebalancing, right? And it'll lead to higher hedging costs for us. Now, the great challenge to getting rid of the curvature risk, i.e., hedging gamma, is that we have to use another option to hedge that risk. We cannot use linear instruments, meaning the underlying shares, to offset the curvature in the option price. So, how do we do this? The underlying, the procedure here is to find a traded option, right? And we can observe or calculate the gamma of another traded option, right? That's step two here. Um, And we can take a position in the other option that completely offsets the curvature risk of the option that we've written, right? And when we do that, and once we combine the full delta position, right? So we had a particular delta exposure when we wrote those options, and then we bought another option to offset the gamma from our written option exposure. Now we have to calculate the full delta exposure and then rehedge the final delta exposure from our combined portfolio. All right. So um, the procedure just strategically here is we wrote an option, let's say option A. So we have a short position in gamma. Okay. So we have to buy some number of units in option B here, such that it offsets our full gamma exposure, such that by the end, we'll have a gamma equal to zero. And of course, now we have a combined delta exposure between the option we wrote and the option we bought. So we'll have to adjust our stock position to make sure our delta is also zero. And when we combine that, then our book, right, our written exposure is locally insensitive to both small moves and big moves, i.e. curvature, right? So this gives us a delta neutral and a gamma neutral exposure um, to any moves. So let's look at a worked example here. We're going to do a delta and a gamma hedge here. So let's say we wrote option A, okay, up top here. It's got, 3 months to maturity. It's got a delta 0.572 and a gamma 0.0314. So we wrote this option, so we're going to hedge that gamma, right? So this is the gamma we're going to hedge to start with. And we see another option out there on the same underlying. It's got, 9 months to maturity. It's got a different delta. It's got a different gamma. So we need to buy some fraction of option B here and then eventually trade in the underlying shares to get delta and gamma neutral. So let's deal with the gamma first. We always want to hedge the nonlinear exposure first. So how do we do that? Well, basically, we just look at the ratio of gammas that we're hedging, right? So we know that the gamma for our portfolio is 0.0314. That's a negative exposure, right? Because we wrote that option. And then we have the gamma here of option B. This ratio effectively gives us the number of option B shares that we uh, need to buy. Another way to intuitively think about this formula is, your setup should be the following, right? We have a gamma exposure to option A, and when we combine it with a gamma exposure to option B, right? B should be equal to zero, right? And so that's where we get this, sort of ratio, looking at the ratio of these different options here. And of course, option A we wrote, so it enters as a negative value. And option B we're going to be buying, so we'll be long gamma on that particular one. Um, and so when we calculate the number of shares here, we'll see here that clearly we need to buy, because our written exposure, for example, our written exposure gave us exposure of negative 0.0314 gamma, and we're buying one with about half of the gamma exposure. So we need more than one share. In this case, we'll need to buy 1.79 units of option B. Okay. And that'll give us our net gamma equal to zero here. Now, remember, we shorted option A, say 1 unit, and then we just bought 1.79 units of option B. So we need to calculate our net delta. So after we buy option B, right, our net delta can be calculated as that ratio, right? Our negative exposure to delta from option A that we wrote and 1.7907 of option B that we wrote, that delta. And when we calculate the net delta of our combined position, we'll see that we have a positive delta of 0.5451. So in order to now move towards a delta neutral position from this combined option position, we'll need to short, right, that number of shares, 0.5451. And by doing so, to kill, once we've killed our delta here, we are now delta and right gamma neutral in this particular example. Again, how did we get there? We hedged the gamma exposure first, the nonlinear exposure first by buying 0.17907 units of option B. And we take the combined delta exposure of option A that we wrote and option B that we bought, and found that delta to be 0.5451. And since that's a positive delta exposure, we need to hedge that by shorting the equivalent number of shares because delta is linear in the number of shares. Now, our next Greek here is tied intimately to gamma, and that is something called theta. What is theta? It's time decay. Theta is the rate of decay of an option value with respect to change in time, right? So that's what you see here is in terms of the first partial derivative, right? It's how the option price changes with respect to changes in time to maturity, T. The closed form solution here, according to the Black-Scholes-Merton model, looks something like this. It's quite big and ugly, but again, this is largely just um, plugging and chugging. With the exception here, I need to update this. This should be an exponential here, right? So I'll update that slide for you. But in terms of its understanding here, we're going to refer to theta as uh, as the rate of decay of the option value with respect to calendar time. So for calls and puts, for long calls and puts on non-dividend paying stocks, we'll keep it simple. Theta is almost always negative, right? Which is to say that the option bleeds value as expiration comes closer, right? So this is why we call options, or we name options, a wasting asset, right? Because the theta eats away at the value every single day. Um, the magnitude of theta loss, kind of the opposite of gamma, is that it's largest for at the money options near expiration. So, because the idea here is that deep in the money or deep out of the money options are barely going to be decaying any theta because it's almost certain what the payoffs are going to be, right? And so those payoffs won't depend on time. It's either going to expire in the money or out of the money, right? Um, so time decay is a long option holder's enemy. And then, of course, the opposite is true for whoever writes the option. Theta is your friend, right? You gain money every day that option stays alive and at the money in particular. Um, so for a delta neutral portfolio, theta is a deterministic component of the profit and loss statement of the position, um, whereas gamma kind of drives the random component. So let's formalize this on the next slide here, the delta gamma theta relationship. Now, all three of these are linked by the Black-Scholes partial differential equation here, expressed at the top of the slide here. So theta plus the risk-free rate times the share price times delta plus half the variance times the square of the share price times gamma. And this is all equal to uh, R pi. So R pi here is just telling us, pi is the portfolio's value, and R is just the risk-free rate. So um, essentially, for a delta neutral portfolio, and I'm going down here, when you neutralize the delta, obviously this component, and I'll just kind of cross it out here, this component this component here falls out and you're left with this guy. So when you're delta neutral, only theta and gamma are governing the portfolio's evolution. That is, between the rebalances. And so you'll notice here there's this tension between theta and gamma, and we call this right the gamma and theta trade-off. um, the intuition here is that the portfolio for a delta neutral portfolio, it's basically earning the risk-free rate, right? It's essentially riskless return on capital because of this trade-off between between theta and gamma, they trade off one for one with opposite signs. So the sort of practical reading of this is that if your book has a large positive gamma, then you should expect a large negative theta as well. They basically cancel out under the no arbitrage condition. So this is why gamma trading strategies always carry the cost of theta, right? You pay daily time decay in exchange for the right to profit from realized volatility. So the sort of takeaway to think about here is those who are playing in gamma, they're basically buying short dated at the money options. But while they're doing that, they're hoping that gamma pays off quicker than theta decays, right? But under the no arbitrage condition, it should be one for one. So it's this tension, this trade-off between the two um, in the practical market here. Two of the other Greeks we're going to visit here are vega and rho, volatility and interest rate sensitivity. So starting with vega, what is this? Well, this is the sensitivity of the options price with respect to changes in the volatility. So that's the first partial derivative you see here. Um, Now, strictly speaking, the Black-Scholes-Merton model assumes a constant sigma. Okay, so such that it allows vega to be internally consistent here. In practice, how do we calculate sigma? In practice, we calculate it by seeing how the Black-Scholes-Merton model price changes as we use different values for volatility. So we call this the implied volatility. Um, and we'll talk quite a bit more about implied volatility later on, but effectively, implied volatility is what you observe um, um, when the option price is visible, right? We know all the inputs for the option, including the price, because we can see it on the market, time to maturity, all these other things. What we can't observe is instantaneous volatility. And so that's sort of the output from the model. We'll revisit that later. For now, you'll see here for vega, that is, again, the change in the call price or the put price with respect to changes in the underlying volatility. Vega is always positive, right? Long options are always benefiting from higher volatility, both calls and puts. The higher the volatility, the more the put or call price. Where is Vega the largest? Well, at the money and longer dated. The more time to maturity, the more volatility has a probability of, causing this option to be in the money, regardless of whether it's a call or a put, right? Um, and the hedging, in terms of hedging volatility or vega here, it's exactly like gamma. Because it's nonlinear, you can only use options that have some meaningful vega exposure to hedge an option that you've written. Again, linear exposure, the underlying stock, has zero vega, right? So you have to use another option. So let's take a look at a hedging example for vega. So we want to match our vega exposure and then sort of reaggregate in order to kill our delta, just like we did before, okay? So here's our current portfolio. We've got a delta of 0. We have a gamma of -5,000 and a vega of -8,000. Now, if we focus only on hedging our vega exposure, so our vega exposure here is -8,000. Then if we take a look at option 1 and use that to hedge our vega exposure, you can quickly intuit here that since option 1 has a vega of 2, then when we divide, 2 into our 8,000, as it were, then we need to buy 4,000 of option 1, and that'll nullify our vega exposure. Now, the problem, of course, is that um, this adds some delta to our portfolio, right? So if we buy 4,000, right, of option 1, well, option 1 has a delta of 0.6, which means we now have a positive delta exposure of 2,400. So in order to get rid of that delta exposure, remember our starting position of delta for our current portfolio was 0 to begin with, so that's why we don't have to worry about it. So in order to get rid of our delta exposure after buying 4,000 units of option one, we need to short 2,400 underlying shares in order to flatten out and get rid of our delta. So now we're now delta and vega neutral, but we are not gamma neutral. Why? Well, because we bought 4,000 shares of option one, and option one has a gamma of 0.5, right? So we're now exposed to a gamma of negative 3,000. So, as you might imagine, we might be keen to get rid of that exposure, right? This leaves us with a fair bit of risk here. So, on the next slide, let's take advantage of how to do that because we have two options that I listed on the prior slide. So, coming back here, we've got option one and option two. We've only used option one. Now we're going to use option two to help us with our gamma exposure. So what you're going to get a sense for here is that each time we add an option to the hedging program, it can introduce another risk, as it were. And so we'll need another option, right, in order to get rid of that nonlinear risk that we've just created. So let's do that. So keeping this in mind for options one and options two, we've got these delta exposures, we've got gamma exposures, and then we have these vega exposures. And so we're going to use this in the next example here to make it gamma, vega, and delta neutral, right? So how do we do this? Essentially, all we have to do is set up a system of two equations with two unknowns, okay? We know that our starting position for gamma of our portfolio was negative 5,000, right? So if we go back to the prior slide, our starting portfolio had a gamma of negative 5,000. Now we know that option one has a gamma of 0.5 and a option two has a gamma of 0.8. I'll just go back a slide and we can see that is in fact true, right? That's our information there. Now, we'll do and we set up that first system of equation, right? So in terms of the weight in option one, we know that it has a gamma of 0.5, whatever weight we have in that, that'll be the number of shares. And then option number two has a gamma of 0.8, and so we'll have to determine how many shares, how many options of that one to buy as well. And so we set it all equal to 0 because we want to be gamma neutral, right? Next, we set up our second system of equation here, and that is we start with a vega exposure of negative 8,000 on our portfolio. Option one has a vega of 2, and we'll have to determine what that weight's going to be. And then option two has a vega of 1.2. Again, we'll put in W2 to represent the weight in that option. And we set it all equal to 0. Now we have a system of equations, two equations, two unknowns. We can use some basic, middle and high school math in algebra to solve for the different weights and weight in asset one and weight in asset two. And when we solve those equations, we see that the weight in asset one, in this case option one, is 400 of those options, and the weight in option two is 6,000 of those options. So when we've done that, that is when we bought 6,000 units of option two and 400 units of option one, we're now gamma and vega neutral. Now we have to take this combined portfolio because we just bought two options with positive delta exposure. So we need to calculate the delta that's added by these two new options, right? So 400 of option one times its delta plus 6,000 of option two times its delta gives us a positive delta exposure of 3,240. So in order to restore our delta neutrality here, we just need to short that number of shares. So finally, now we're delta vega and gamma neutral, and that's the objective here. In terms of rho, what is rho? It's just the sensitivity of the option value with changes in the risk-free rate. And it has a similar closed form solution that we've seen before. And so kind of using the parameters of this example that we've used throughout the lecture here, we can compute here that rho is equal to 8.91. And the basic interpretation here is that a 1% rise in the risk-free rate raises the call value by almost, in this case, about 9 cents, okay, per share, right? And that's what we see over here. So in the case of 100,000 underlying shares, this is equivalent to 8,900 bucks and change, right? Which, is a relatively modest change compared to the other effects, delta, gamma, and vega. So we tend to focus more on delta, gamma, and vega. So most traders really only worry about rho for really long dated options when the cumulative effect of discounting really matters. Um, and we'll wrap up here and talk about hedging in practice. And specifically, you know, we've gone through the theoretical impact of the Greeks, and now we're going to introduce how messy markets kind of put a lot of these assumptions in jeopardy, as it were. So, how does this actually look on a trading desk? From a trading desk perspective, banks typically aim to keep the delta near zero, throughout the day or at the end of the business day, right? And in terms of gamma and vega hedging, right? They'll do that a bit more opportunistically, maybe when, say, client flows naturally hedges them, or otherwise they might tolerate the exposure, um, unless they can, potentially hedge it cheaply. And in practice, most of the delta hedging tends to take place with futures options rather than trading in the individual underlying stocks. Um, so they use index futures because they're cheaper and faster to do, particularly in a large book of stocks, because, right, we know that diversification, if you have over 30 options, for example, options written on over 30 different stocks, you're approaching a diversified portfolio, which should approximate market moves. So in index futures, delta hedging is relatively straightforward to do, right? Um, and it's going to be easier to hedge larger portfolios because the law of large numbers typically smooths out those individual name idiosyncratic risks, right? Whereas, if you had one position, it'd be much harder to hedge with futures for sure. You'd have a lot of basis risk in that case. In terms of using futures for hedging, delta here, it's pretty straightforward, right? We just match the delta of the option with the right futures position. Mechanically here, right, the delta of the futures position is equivalent to E to the R minus Q times T. Because remember, index futures pay dividends, right? So we have that Q in there. Um, just mechanically, if you recall, remember the futures price is equivalent to the spot price um, that's just grossed up by the difference between the risk-free rate and the dividend yield, right? So when if we have a dollar for dollar hedge, or the delta as it were, this equates to a delta in the futures just being equal to sort of that exponential. Okay. Now, um, for an option with that that has no income, that is Q is equal to zero, well, then the scaling factors, right, is just the sort of present value of the scaling factors, the present value of a dollar. So it's going to be slightly less than a dollar, basically, your delta. Sorry, not a dollar, but your delta is going to be slightly less than one. For options with a dividend yield of Q, then in the case where Q is, greater than R, that is the dividend yield is greater than the risk-free rate, the futures will move a lot less than the spot rate. So we'll need to use more futures in order to hedge. And the opposite is true if the dividend yield is less than the risk-free rate, then the futures move a bit more than the underlying spot. So we'll use fewer futures contracts. And it's mechanical. You can see it here in the relationship. Now, in terms of, how practitioners typically use futures, They typically use it in portfolio insurance products, right? And this is the classic dynamic hedging problem because many banks, insurance companies, even pensions and institutions write these or try to obtain these portfolio insurance products, and someone has to underwrite them. So um, the problem with the dynamic hedging is that it's pretty expensive, right? So what we might want to do instead is to synthesize a protected put without actually buying one. So how do we do this? Well, instead of buying the real put, which is going to cost that premium up front, the manager might synthesize one by dynamically adjusting the stock holding to match, right, the delta of the put's profile. So if you think about it, a long stock position plus the dynamic rebalancing would be equivalent to the stock holding plus a synthetic put. So we're creating a protective put by well, portfolio insurance is basically a protective put. They're tautologically the same thing. The problem with this is the following, right? So as the portfolio rises in value, that is, the share price goes up, then the put delta, right, becomes less negative. That is, it goes closer to zero. So then the manager can unwind the hedge here. That is, you can buy back some stock. Um, excuse me. Whereas as the portfolio falls in value, that means the put delta becomes more negative, and so we have to increase the short position and sell some stocks, right? Um, so sorry, I think I said the first part wrong here. So as the portfolio rises, we end up, the put delta becomes less negative. And so if we've written, if we have this exposure, then we basically buy back the stock because that put delta becomes less negative. So we're unwinding the hedge, as it were. And as the portfolio falls in value, then the manager increases that short position, right, by selling stock or typically futures. So the result in as the portfolio falls is the portfolio becomes more protected on the way down, and as the share prices, the portfolio captures more of the upside. Now, the this mechanic, selling on the way down and buying on the way up, is normally fine in a slow moving market. But in a crash, right, all portfolio insurers are doing the same thing. They're selling at the same time. So here's some practical problems with delta hedging. When the assumptions break, the hedge breaks. So problem number one here is that we're chasing delta. So in a fast moving market, the price changes faster than the trader can compute and execute the rebalance. So the hedge is always behind. The second problem is that there are gap openings, which is to say that markets close and then reopen at some potentially discontinuous price, right? And it reopens it reopens at a different price because of overnight news or maybe over the weekend something happens. And so the hedger can't trade during that gap. And the third part here is a rush to the exits. That is, in an extreme market, exchanges may suspend trading or impose circuit breakers. So even in the NYSE, if share prices change by too much, 10, 15%, depending upon the shares, then the NYSE says, hey, everyone take a break, stop trading for 15 minutes. And so banks will not be able to trade out of a position at all. So the pattern is potentially damaging in that dynamic hedging needs an orderly continuous market, but crises break that assumption. And of course, that's exactly when you need the hedge to work most. And this led to the largest single day drawdown in the markets on October 19, 1987, where the Dow Jones index fell almost 23 percentage points, which is still the largest single day percentage decline in US market history. So what happened? Well, you have a bunch of portfolio insurers. You can think of pension funds and other institutions running dynamic hedging programs. Um, and effectively, they're systematically selling throughout the day, right? So as they do that, as the market falls, put deltas become more and more negative, which demands more selling, right? And that selling drives the market down even further, demanding even more selling, right? So this is a positive feedback loop. And the Brady Commission, which is, set up by Congress, investigated and later estimated that portfolio insurers' selling pressure accounted for most of the total market futures volume, throughout the day. Um, What's also interesting in this example is that markets dislocated in that futures fell faster than the spot market because that's where insurers were selling. They were using futures markets to sell. And so there was a disconnect between spot futures parity condition. It broke, right? So that arbitrage between spot and futures broke down. So the lesson here, of course, takeaway is that dynamic hedging strategies that work for a single user can be destabilizing when everyone else is doing it and following the same rules simultaneously. So, in summary, here's the formulas for all the Greeks. And some key takeaways I want to leave you with is number one, the Greeks are local sensitivities, right? They predict small moves. Delta is directional, right? It's necessary, but not a sufficient hedging condition. Gamma matters too, right? That is to say, especially near expiration and at the money. And importantly, this trade-off between gamma and theta via the BSM partial differential equation says that gamma buyers are paying theta. Volatility is hedged like gamma. Only options have it, so you have to use another option here. Again, it tends to only really material affect the hedging program for long for sorry, it impacts sorry it impacts long options because call and put options are positively affected by increases in volatility. And in terms of interest rate sensitivity, we mostly think about this in terms of long dated options. In terms of real world hedging, of course, daily rebalancing does assume these orderly markets. So you have to be careful around some of these assumptions because that's what the 87 crash showed us that, that the assumptions can fail catastrophically. And so in our next lecture, we're going to talk about implied volatility quite a bit more and what they really tell us about how real markets deviate from the Black-Scholes Merton formulas. All right. And with that, I will see you on the next one.